Hey, John, always good to see you.
Thank you, Carl. Good to see you.
Well, as you know, the year has started rough for the muni market with pretty challenging endeavors and yet a quick reversal in the near term where everything seems to be going in the right direction. Can you speak a little bit to the cause for the change and the redirection of the market?
Sure, yeah. As you point out, it's been an interesting first almost 3 quarters of the year thus far. Munis have really lagged other fixed income asset classes. But in my view, not because there's anything fundamentally wrong with the municipal bond market, nothing wrong with the credit trends. The tax exemption is still in place. It's been essentially affirmed by the One Big Beautiful Bill passage. And really, the softness, which is just now starting to reverse, has been highly, highly technical. The uncertainty has caused long-term fund flows and other long-term product flows to be rather tepid. At the same time, there's been a very, very heavy amount of supply, and the Fed has been on a pause. So those things are starting to change. We're seeing a normalization in those supply trends, a pickup in demand for municipal bond products across the entire yield curve. The Fed is getting ready perhaps to restart its interest rate cutting program, which all else being equal, those factors will be favorable for municipal bond market performance. And we're just starting to see some yields come down, and we're just starting to see some of the index performance flipping from slightly negative to slightly positive. I think, potentially much further to run, but we're just starting to see those improvements right now.
Well, the news is filled with dialogue about new Fed members, other Fed members out, a lot of drama in the marketplace. But what do you think the Fed is going to do, and what does that mean to you for the future of interest rates, balance of the year and next year?
Yeah, a lot of drama, as you point out, but I think they are sticking to their knitting. They have a dual mandate of maximum employment as well as stable and low inflation. So just recently, particularly at the Jackson Hole meeting, Chairman Powell's speech really emphasized that he's growing more concerned about the labor market and was somewhat benign in terms of his opinion of inflation trends. So that started to cause markets to change, pricing in more Fed rate cuts, starting to price in the first rate cut being mid-September. And I think that is in part because we've seen a lot of revisions to job growth. And both in the most recent employment report release for the month of August showed sharply downward revisions across the summer months, but then also the benchmark revisions essentially erased half of the job growth over the last year, from an average job growth of 147,000 per month to only 70,000 per month. So that's the actual kind of results of the most recent statistical analysis. That sort of dovetails with Powell's recent comments about becoming more concerned about the sluggishness of the pace of hiring and less concerned about inflation. So as a result, we now have essentially 3 cuts are priced into futures markets, totaling 75 basis points for the year 2025. And then I know it's a little early to rely heavily upon this, but another 3 cuts totaling another 75 basis points next year. Now, those can change, but I think what the market is saying, we're 150 basis points above the neutral rate, and the Fed needs to get to the neutral rate. And all else being equal, that would tend to pull longer-term interest rates down. Of course, the Fed operates on the short end of the yield curve. Muni bonds tend to be priced intermediate and longer on the yield curve. But still, if the short rates are falling by that kind of magnitude, then intermediate and longer-term rates would fall as well.
That's great. Well, we've definitely seen a steepening of the yield curve this year and very attractive, higher yielding municipal bonds. I think you pointed out it's 20-year highs in municipal bond high yield rates today. How do you feel about the broader municipal market and the fundamentals? We know there was a technical sell-off, but fundamentally, how are you feeling about it, and is this an opportunity?
Yeah, a couple of things that I always look at on the fundamental side are the upgrade to downgrade ratios and how much taxes are being collected. Upgrades significantly exceeded downgrades for 4 years in a row, with the last year being 2024. Now, thus far in 2025, it's more neutral, approximately equal, upgrades versus downgrades. I would say that's not dramatic improvement, but it is stability. Some of the most important collections in terms of tax revenues are property taxes and personal income taxes. Both of those are still growing in the low to mid single digit pace. And that means that municipalities have the resources. Now, it's an incredibly diverse and differentiated market. GOs collect taxes versus revenue bonds collect user fees. There's a lot of infrastructure upgrades going on, which has produced a lot of bond supply, but the debt levels appear very, very serviceable right now. And I would say the credit conditions are generally overall stable. The market has pulled forward, I think, a lot of the supply. We've already seen 400 billion priced by mid-September of 2025. That can usually be the amount of debt priced in an entire year. And so we have the entire fourth quarter left to go. So it'll probably exceed 500 billion by the time we get to the end of the year. But a lot of that supply has been pulled forward. Normalization of that supply should help performance. The credit trends that we are seeing look very, very stable to us so far.
Thank you for the time today, John. Appreciate it.
Thank you, Carl.